Do you want a financially secure future, not just for yourself, but for your loved ones as well? This is Generations of Wealth, the podcast that breaks down the most effective wealth building strategies you can easily apply to your own life. Join investor and international best-selling author Derek Dombeck in exploring practical tips and sound advice on building a profitable business, creating a powerful brand, or getting into the thriving world of real estate investing. This is your chance to create your very own financial roadmap to live your vision, love your life. Let's begin this discussion with your host, Derek Dombeck.
Welcome to the Generations of Wealth Show. I'm Derek Dombeck, your host, and this show is going to be no different than all of our other shows. It's awesome. We've got a younger guy, right? We've got a guy named Tom Keating who he started out right out of college and he's killing it. This episode is awesome because Tom and I are talking about the differences between our generations, and he started in 2018. I started in 2003. So just knowing that we can learn from each other's experiences depending on how long we've been in business as well as our age category. It was an awesome show. Before I bring on Tom, I do want to thank everybody for following us. If this is your first show and you just found us, welcome. We appreciate you. But anybody that's been following us for a while, we'd love to have you just spread the word, right? Grow the Generations of Wealth family. Tell everybody, go listen to this show and give us all the love on socials, and get out there and rate us. Give us the thumbs up, the 5 stars, the shares, the likes, the loves, all that stuff. So with that said, let's get on to our guest. And now, as promised, the man, the myth, the legend, Tom Keating. Tom, welcome to the show. Why don't you let everybody know a little bit about who you are, and we'll dive right into your story and what you're doing right now.
Awesome. Thanks, Derek, for having me. I really appreciate it. So as you mentioned, my name's Tom Keating. I originally grew up in upstate New York. Went to college and ultimately studied business and went into finance, went to work for a large bank, and found real estate on accident, really. I was reading a book at my local library and learned about house hacking. That's buying one residential dwelling, a 2-unit property, and living in one unit and renting out the other. And that's kind of how I got started in real estate, probably about 6 years ago. And since then, I've been able to build the portfolio a little bit, and excited to talk to you about it today.
So 6 years ago, you were what, 12 at that time when you started house hacking?
No, I wasn't 12. I was 22 years old, fresh out of college. So a little bit older than that.
Okay. So you got out of college, and I'm going to make some assumptions here, and this will be fun going back and forth with you. But most people get out of college, 22, they've got a mountain full of debt, and they're trying to figure out how to get their feet under them. You jump into real estate. Did it have anything to do with your degree and what you learned in college, or was the real estate business a new learning or a continuation of what you already had?
Yeah, good question. So I would say what I learned in college was business, right? Like I studied finance, so I knew the basics about numbers, and I ultimately started working for a large bank. So numbers made sense to me, and I was learning the debt piece while working for that bank. But in terms of buying your own properties and investing and stuff like that, no, I really didn't know much about it. At first, it was kind of self-taught, right? I would read a lot, I would listen to podcasts. So no.
Okay. So when you started your journey and you're working for this big bank, have you always just used banks for your deals, or what's your financing look like?
Yeah. So as far as financing goes, that very first year, I got that job with that bank, and it was a rotational program. So I got to experience different parts of the bank, and really was traveling a lot for work. And when I wasn't, I was living at home with my parents. So that allowed me to save up a little bit of cash. So obviously on each property, I have a little bit of equity and then debt, right? So typically we'll see about for the non-owner occupied properties, you see about 75% LTV, so 25% equity. And those loans have typically come from banks. Some of those first banks were actually some of those first loans were from the bank that I worked for in upstate New York, and sometimes we'll use brokers as well to get the best terms on the debt, best rate, best amortization schedule, stuff like that, loan to value. But yeah, primarily debt financing combined with equity.
Okay. And is that your plan moving forward? Because a lot of what you talk about and what we're going to talk about on this show is we're in a different market than when you started, right? With especially with rates. So
Yeah,
what do you think is going to happen with rates, and what's your plan for that?
yeah, great question. So as far as rates go, I mean, obviously, it's expected that they're going to decrease over the coming months, but I don't anticipate that in any underwriting, right? I would assume that any sort of refinance is just it's the cherry on the cake. It's not expected. So I underwrite every real estate deal today as if with the going in interest rate and assume it's never gonna go down, and hopefully it does. Um, and then you got to get creative, right? Because when I first got started in 2018, it was a great market. So I think the interest rate on some of my first properties were 3%, 4%, 5%. You're not seeing that today, especially on non-owner occupied, especially on the multifamily. There's inherently a larger risk to the lender, so they're going to charge you a higher rate. So today you got to get creative. You got to do things like maybe add a bedroom, right? So some of my rentals are student rentals in upstate New York, right around college campuses. Um, I might go in and see, hey, there's 2 bedrooms in this apartment, but there's also 2 living rooms. So we really need a second living room. Maybe we can convert that to another bedroom, because oftentimes students pay for rent by the bedroom. So that's one way that you could increase revenue in today's environment. I know, for example, on a recent purchase, we get say we get $500 on a bedroom. It might only cost us $1,000 to put up a new wall with a door and a closet and call it a bedroom. I mean, you're getting your money back in 2 months there in that situation. So you got to be creative with space in today's environment, given the higher interest rates for sure.
Yeah, we've actually got a building that we converted into a 12-bedroom, 6-bath facility and lease out per bedroom. And it was like a group home for troubled teenagers. And so originally it was 8 bedrooms and 4 bathrooms. That was an interesting project. Just the conversion was easy because I have the construction background and that doesn't bother me, but the management of 12 strangers sharing bathrooms, and we've had that for about 3 years now, and it's been a unique experience, to put it that way.
Do you provide do you provide like a cleaning service for the common space? I'm curious, or do you provide like toiletries, stuff like that?
We don't provide toiletries other than the first day they move in, they got kind of a little starter pack. We do have a cleaning service that comes in there, does the common areas. We've got camera systems in the common areas and the parking. Trying to cater towards traveling professionals, nurses, construction workers, but we get all kinds of different types of tenants. And
Yeah. I've
it's
definitely noticed that those working professionals who are coming to town, like you said, travel nurses, they take good care of the property. They're primarily there to work, and they just want to go home and go to sleep. So I think that I've heard great things about that. So that's awesome.
Well, the hard thing actually is the different shifts, right? So you might have a traveling nurse that works all night, and now she's in a common space, or not common space, but she's in a building with other people living there that are awake during the day. So it's a challenge for them to sleep. There a lot of those little things you don't really think about until you're in those situations, and you're like, now what? Uh,
Yeah, I never thought about that. Interesting.
yeah, and as much as you try to reduce noise, it's impossible, right? Doors slam and people are walking up and down stairs. It's just part of it.
Yeah. Huh. And do you do 12-month leases on or I guess they're shorter term leases as well? And then if you have a
Yeah, typically we'll go as little as a week.
oh wow.
But
Okay.
most of them are a month to 4 months.
Okay.
And now I've got people managing it. I actually lease optioned it to friends of mine, um, because my original business partner that I did that project with, we're no longer business partners, and I didn't want the management of it. I never wanted the management of it. So I've lease optioned it to friends of mine, and they're doing a great job with it. So
That's awesome. Yeah, the leasing part is probably not it's not the most enjoyable part. So it's good when you could offset that if you can.
well, it kind of takes away from what I love doing, which is this,
Yeah.
and that's really what we have to choose when we're figuring out our vision for our business, is what do we want to do and what do we not want to do. And I've got plenty of stories in the last 20 plus years of about tenants. I don't need or want more stories about tenants.
I hear you there. That's funny.
So let's go back to you started with the first duplex. And so how did you build from there? What was your steps, your next steps?
Yeah, absolutely. So I bought that duplex, and I realized, well, I'm living downstairs. I have my tenants paying rent upstairs. Um, all of a sudden, they're pretty much paying my mortgage every month, right? So now I'm able to save that second year's salary while I'm working for the bank, because I'm pretty much living for free. My tenants are paying my mortgage. So then I was able to go out and buy a triplex, and kind of do the same thing all over again. At that point, I was living in a building with 3 apartments on 3 bedrooms, 3 units with 3 bedrooms each. So 9 total bedrooms in the building. I had 6 students living upstairs in the 2 units upstairs. And then in my unit is a 3 bedroom unit. I'm only 23 years old at this point. And I actually said, okay, I'll take the master bedroom in this one and I'll rent out the other two rooms in here. So I had a med student and a law student who were more my age who were living with me in that unit. Now I'm living in a building with eight tenants and do my best to make friends with the students upstairs so they don't trash your place and throw big keg parties or throw because I swear they had a dartboard and they never hit the dartboard. There was a hole in every place in the wall but the dartboard. So yeah, that was my next purchase, and slowly kind of continued that and did the small duplex triplex thing, and ultimately thought, I was like, wow, this real estate thing is kind of cool. This is what I'm thinking when I'm working at the bank. I was like, I'm really enjoying real estate. Um, I would love to make this like my full-time career. So decided to go get my MBA from University of North Carolina, because they have a great real estate development program, and it was in the South. And I like the South for a myriad of reasons. Warm weather, huge college football fan, but also because of the great real estate down there. At the time, this was back in 2020, you were seeing appreciation through the roof, rent growth going crazy. I was like, okay, it'd be great to transition there from a lifestyle perspective and then also for the real estate opportunities. So went to school in Chapel Hill, ultimately post business school after 2 years of doing that. Worked for a developer, so ground up construction on grocery anchored shopping centers. Did that for about a year and got the itch again. I really wanted to go back and work for myself. It had always been a goal and a dream of mine. So continued to grow and scale this small multifamily thing.
So okay, so you started growing your multifamily thing. Now you're in North Carolina. You
Yep.
still have some properties in New York.
Yeah.
So what was that transition as far as management like for you?
Yeah, it was really tough at first. I relied on friends and a network of people that I had met through like the local real estate groups, right? Um, I had one I still have one guy who will help me lease out apartments when I'm not there. So he has a great personality, very charismatic. So he'll help out when tenants are looking to at a vacant unit, right? To see if they would want to be a tenant there. And then I have someone else who is great. He's a handyman, right? He could do pretty much anything. He stays away from like plumbing and electrical, but can do all the basic stuff. He could paint, fix leak and sink, stuff like that. So he does that. And I actually think it was kind of a blessing in disguise because when I was there, I mean, I'm not the most handy guy, so I was trying to YouTube everything. It was taking so much time out of my day. The fact that I left New York and I'm not going to fly up there to fix a leaking sink actually helped me take a more hands-off approach, focused on finding new deals, and it allowed me to offset some of those tasks that saved me money in the short term, but my time probably wasn't worth it in the long term.
That's for sure. And I had done the same thing when I first started, meaning I was buying rental properties in Wisconsin, but I was also investing in Florida real estate. And then the markets crashed in '07. So, um,
Tough
you know,
time to be in Florida in real estate in general,
right,
especially.
right.
Yeah.
And the reason I bring that up is because I had to grow relationships and find people that I could trust or thought I could trust. And that's everybody that wants to invest remotely, they all have to go through that phase and figure that out. And I feel like it's a lot easier now with the internet and being able to do background searches on people very easily and quickly versus back then. It was very much word of mouth, and you knew somebody that knew somebody, and they hooked you up. But when the market changed and corrected, all those people that I thought I could rely on, poof, they were gone, right? I mean, jobs dissolved, people disappeared. There was just a lot of drama and trauma that came from that. So I want to kind of compare a little bit between you getting started at a young age, which is awesome, and doing it in a market that was consistently increasing. Now we're starting to see the leveling off of the market. What do you think in your age bracket versus my age bracket? What do you think is going to happen in your business in the next 5 years based on what
Yeah.
you see in the market?
Yeah, it's so tough to predict. I feel like I mentioned this with interest rates earlier. I feel like it's very hard to do. Like you can't predict the stock market, you can't predict interest rates. You hope for the best, but ultimately you kind of plan for the worst. So I almost think of it as, okay, if I can reduce my leverage, right? If I make sure I keep LTVs, loan to values at like a low enough rate, that should help. We want to make sure we're cash flowing not 1 or 2% on each acquisition, but maybe 7, 8, 9, 10%, right? I mean, each of these ways are each of these things are ways to reduce my risk, um, if we do come to those times. Because as you mentioned, I'm on the younger side of people investing in real estate, and I plan on being in this for realistically the rest of my life, right? I love real estate. I can't see myself ever like fully retiring. I mean, I like to do the things that I like, but I also like real estate. So for the rest of my life, I'm going to be doing this. And ultimately, there is going to come a time where there's going to be a market downturn. Hopefully, not as severe as what you experienced in 2007, 2008. But when we do get to that point, hopefully, I'm prepared because we do have those. We have put those things in place to reduce that risk for sure.
Well, and I can tell you from my experience and the people that know me and listen to Generations of Wealth podcast and see me at other events or speaking on other people's shows, um, you make decisions based on the knowledge and information you have at the time. So at the time, 2005, 6, 7,
Yeah.
we weren't over leveraging. We were doing 80 to 90% LTVs in a growing market, which at that time seemed wise because there was many people that were doing 125% LTV loans. And,
Yeah.
but when those markets crashed and they went down by 75% in value, it didn't matter what LTV you had.
Yeah.
you know, Now I don't think that we're going to see that severity, hopefully again in at least my lifetime. Um, but there can be black swan events like COVID. So just after you moved to North Carolina, COVID hits. How did that play out for you? Because
Yeah.
that was your first big hiccup in your real estate career, I'm assuming.
Yeah. Oh, for sure. That was extremely frightening, right? Because as I mentioned, I was living in Albany at the time, and I was renting to a lot of college students. Well, this is March 2020. I didn't move to back down to North Carolina. I didn't move to North Carolina for business school until August 2020. So I was still in Albany at this. I was still in upstate New York at this point in time, and I'm living in this building, as I mentioned, with 8 tenants, right? And every single one of those 8 tenants, they were in either undergrad, they were in college, or they were in a graduate program that ultimately shifted from in-person classes to remote classes. And they were only in this area for the colleges, right? They were there going to school, and ultimately they left, right? Because college closed down, their classes went fully online, and none of them lived locally, so they all went home to live with their parents. Um, And I got very fortunate. I think it comes down to relationships, right? Relationships in real estate are so important, whether it's relationship with your maintenance team, your brokers, your partners, your mentors, whoever. Every single one of those people, because I was living there, they had a personal relationship with me. They continued to pay rent for the remainder of their lease term, right? So their leases ended at the end of May. So they could have not paid March, April, or May rent, but every single one of them did. And I think that came down to relationships and getting to know people. I obviously am not in the same situation now where I get to know all my tenants on a personal level. So that's one thing I was very fortunate with at the time. Um, but for sure, that was one of the scariest months I've experienced in my career. I was like, I can't afford for all 8 of these people to not be paying rent, especially when I was just starting out. So definitely a frightening experience for me, and I got very lucky with it.
Yeah, and that's the part that, going back to my history, when I was starting out, I used banks for everything. And then I realized I had no control over my business when the banks were shutting down, or the relationships I had built with my commercial loan officers, and those loan officers are getting walked out the front door with a box of, their stuff off their desk, right? So I bring all these up because it is, we are 20 years apart in age, and a lot of different experiences, but we can learn from each other, and we can
Oh,
learn from each other's generation, right? So I see this is an opportunity. Like, I want to see up and down markets, because after you live through a couple down markets, it's like, the end of the movie. You start to see things that are not really hard to see, but the majority of people don't.
yeah.
And that's opportunity, right?
Yeah, that's exactly right. So I'm guessing, so obviously 2008 happened. I guess my question for you is how long of a break did you take, and when did you jump back into real estate?
Well, I never took a break, but
Okay.
I had to shift,
Okay.
because I wasn't bankable anymore. I had eight active foreclosures against me at one time, and that took 3 years to clean that up, because it just took that kind of time with the banks, because there was so many. So we ended up learning how to short sailed all those properties. But I started embracing everything I could find about creative deal structuring and negotiations and sales. And I got better and better and better every day, um, talking to people, to the degree where I actually have a negotiations training course now that I teach people. And for anybody listening to the show, shameless pitch, go to nomeansnotyet.com and check out my negotiations training. So
I love
um
it.
but it was the necessity, because there was not a bank in the world that was going to do business with me for a long period of time, mostly because the relationships I had built were gone, and I had to start from scratch. So I actually have not used a bank for an investment property since 2011.
Wow. Okay. And
I
for
took
the most part, is it hard money loans, or what, where are you finding your financing?
Tom, I feel like you're interviewing me all of a sudden. This is great. No, we started raising private capital for our deals, and then we got to a point where we had more private capital than we had deals. So I co-owned a hard money lending company for the last 10 years, up until the end of 2023. My business partner bought me out.
Oh,
But
very nice.
yeah, so for yourself moving forward,
Mhm.
do you have intentions of looking at alternatives to purchase property other than using institutional funding?
Yeah. So I'm definitely open to that. Sometimes maybe typically the bank debt has been the cheapest up to this point, but obviously if you want to grow and you want to scale, sometimes your ratios aren't the best, obviously. So what I've shifted to at this point is I'll raise outside equity for a portion of the capital. So obviously we get the bank debt. I co-sign on the bank debt with an investor. We obviously have to bring 25% to the table, but because I found the deal, sourced the deal, underwrote the deal, conducted the complete due diligence, my equity partner will provide a larger portion of the equity than I will. So maybe, for example, just to keep numbers super simple, our purchase prices are higher than this. But say we purchase a $100,000 property, we get 75% of it in via loan, and then 25% via equity. Of that 25%, my equity investor might put in 60% and I might put in 40%, but we're 50-50 partners. I'll take a property management fee off the top, 10% for doing like communicating with tenants, getting leases signed, all that stuff. And then we're 50-50 partners after that. So that's how I'm currently structuring deals. Certainly open to, given your breadth of experience, a lot longer than mine. I'm always open to hearing different opportunities and playing around with different financing structures. I'm really a numbers guy, right? So whatever the numbers tell me to do is what I'm going to do. Every deal that I look at as a potential acquisition, I run it through on Excel before I ever go look at the property. So it really comes down to the numbers. It's extremely important.
So when you're running that through Excel, because a lot of people use different software platforms, or they go onto places like Bigger Pockets and use a rent calculator. I mean, everybody's a little different.
Yep.
What are you specifically looking at when you underwrite that deal? And you said you do that before you even walk the property, which is what I do as well. But what does that look like?
Yeah. So ultimately, I'm backing into a cash on cash return. Um, that allows me and my LP investor to compare it relative to other assets, right? So we know that historically over the last 100 years, the S&P 500, the total market is stock, and you can probably expect like 8 to 10%, right? So if we can get an 8% cash on cash, I mean, in a real estate deal, I see that as a stronger investment because not only are you getting that 8% cash on cash, you're also getting things like principal pay down. Every month, a portion of that rent is going toward that those tenants are paying or going towards your mortgage to pay that down. You're also getting the appreciation, right? Historically, real estate in the United States, again, over a long period of time has appreciated. Obviously, you have those ebbs and flows, and you have those extreme downtimes like 2007, 2008. But historically, if you hold for the long term and you could weather the variances, weather the storm, you will appreciate over the long term. And we account for a long hold period where it's not a fix and flip. We're typically going in and we're buying and we're holding for the long term for sure.
Okay. All sound advice for sure. I'm curious about your partnerships, and this is something that it's kind of raw for me yet, because my partner and I, after 10 years, we didn't have a bad partnership breakup, but we did have different visions for where we wanted our lives and our businesses to go. And that's what we're all about at the Generations of Wealth. It's, live your vision, love your life is our tagline for a reason.
Yeah.
But you mentioned that you're 50-50 partners with these people. How do you protect yourself? How are they protected? And do you have buy-sell agreements in place? Like, what do you do with that?
Yeah, great question. So the first one way we protect ourselves is obviously each property is purchased in an LLC, right? That protects us from a legal perspective. It protects us like from a liability perspective, realistically, right? Someone slips and falls. Hopefully, they could just go after that, assuming we don't intentionally do anything bad. For the most part, attorneys have advised us that they could really go after that one individual entity and whatever that holds. So that's one way we protect ourselves. We're conservative in our underwriting. Almost every time we've outperformed underwriting in terms of rents and expenses. So we try to be extremely conservative there. And I'm completely transparent, right? So when I'm raising equity for these deals, what I do is I show them the Excel, right? So I hop on a Zoom call. And first thing we do is do a street view of the properties to walk the neighborhood, understand what the neighborhood is that they're buying, what they're buying in, what it looks like. I talk a little bit about other properties that are surrounding it that I own and my experience with the property management there. And then we walk through the Excel model, right? It's a super quick and easy one-page Microsoft Excel model that backs them into a number. We go over some best case, base case, and worst case scenarios. for how the asset could perform. And I'm completely transparent. And it's all done on probably a 30-minute to an hour Zoom call, in which case I present for about 30 minutes and they ask questions throughout. And I typically have a good idea before even going into that call, if it's a good if it's a deal that someone would be interested in or not. But these are people I've known, liked, and trust for years, and that's kind of how I've gone about it.
Okay, so after the fact, you guys got the deal, you're moving forward, it's in an LLC. You mentioned that they're limited partners, so they don't necessarily have the voting rights or the decision making, correct?
That's exactly right. Yeah. So we have an operating agreement, so which is a legal document between myself and the other individual, and it goes through, I guess each thing of when we're intended to sell, and ultimately we could hop on the phone at any point in time. I mean, that's this business, right? It's all about trust and relationships. So as long as you're communicating with each other and letting them know, hey, we might consider selling this asset. Like, how does this look for you from a capital gains perspective? Like, how is this going to impact your taxes? So those are important things. Constant communication, I would say, is imperative in this business for sure.
Mm-hmm. I actually have a good friend of mine, and he speaks every year on our Generations of Wealth voyage, which is
Yeah.
our cruise. And he puts out a newsletter, and I was reading it the last few days, or I should say the last couple of weeks, because it comes out, I think, twice a week. And he talked about the 8 Ds of business, and each one is something different that you should look out for. And the one that caught me by surprise was he talked about drugs, and specific to an operating agreement should have language in it that talks about what if one party becomes addicted. And it doesn't have to be necessarily drugs. It could be addicted to anything, or they're not performing. And I know very few people that actually put any of that stuff into their operating agreements, right? And it could be not at their choice. They could become impaired from a car accident, or they can no longer physically do what was required of them in that original operating agreement. So yeah, Jeff Watson is the attorney, and anybody listening to this, just go check out. And I don't even know Jeff's email address or his information for sure, but you start Googling Jeff Watson, you'll find him. Or you can check out his information at my website, generationsofwealthvoyage.com, for the cruise. So
yeah, that's great advice. Honestly, that's something that I'm taking away from this, learning from you, because I don't have anything in there that says, hey, what if I become impaired or I'm unable to perform the task? So that's something I'm going to want to go back and have a conversation about. And I appreciate that. That's great advice for me.
I'm trying to remember all 8 Ds. I know there was death, divorce, drugs, disability, and I can't remember the other ones off the top of my head, but it was definitely interesting to think about,
Yeah, no, that's a key takeaway for me for sure.
Definitely. So what's next for you? I mean, what do you want to see happening in your real estate journey?
Yeah, I would say what's next is I would love to grow the portfolio, to do a little bit larger deals. As I've mentioned to this point, I've primarily been focusing on those small 2 to 4 unit properties. So I would love to do a little bit larger deals, um, while still staying in my wheelhouse and making sure that we're doing good underwriting. It's not something too large to handle. And then I like giving back, right? So many people have been incredible, incredibly helpful in my career, and I think I do have an advantage, getting started younger. People want to help the next generation, as your Generation of Wealth um, podcast name implies. So many people have helped me at the beginning of my career. So I love giving back to people who are looking to get started in real estate. I have friends of friends who reach out and looking for advice on buying their first duplex and triplex and stuff like that. So I've started recently a Keating Capital Consulting, a mentorship program, which is less of a program and more just, hey, we're going to have conversations. I'll help you underwrite your first deals. Um, and hopefully we'll get you on a path to success, and also have fun while you're doing it, right? I'll introduce you to my network of of whether it's brokers, lenders, maintenance team experts, attorneys, stuff like that. I just love helping people get started in real estate. I'm so passionate about it. I love it so much, and it's a great career to be in. It really is.
Well, I know that we're going to have in the show notes and in the contact information for you, just everybody can go to thegenerationsofwealth.com/consult with Tom. And you can check that out. You want to get a hold of Tom and see if he's a good fit to help you out in your journey. So that's one more time, thegenerationsofwealth.com/consult with Tom. And a lot of people that listen to my show, they know that I ask this fairly often. Tom, what's one question I should have asked you that I did not?
Yeah, I mean, that's a good question. I guess the thing is, for me, it's what's led to my success to this point, and I would say it's three things. One is people, right? I'll mention this over and over again. Mentors, advisors, people who've been in the experience longer than myself, people who've been in the experience maybe longer than you. They're them sharing their experiences, telling me stories, helping me with running the numbers, super important. The next thing is know your numbers, right? There's no good deal with bad numbers, right? You have to understand what the numbers are, and then finally, it's risk, right? What could go wrong, and plan for that, right? As I mentioned, keeping leverage to a reasonable level is important. Working with really good partners that you know, like, and trust is important. Getting good tenants in your building, conducting good background checks are important. So I would say those are three things that are imperative to success in the real estate industry, for sure.
Well, no doubt about it. And the fun thing about this business and the frustrating thing about this business is it constantly changes. And, as technology changes, I mean, when I started, we used to advertise in newspapers and buy and sell property in newspapers, right? I know that's funny now to think about it, but that was what we did. And 20 years from now, we might be laughing and joking about, we used Facebook Marketplace, and people will be like, what the hell's Facebook? Right? Like, we just don't know. And that's like I said, the exciting part and potentially the frustrating part, because you can get stuck in a rut and get left behind as well. So,
Yeah.
but that's the good thing about, like you said, having mentors, having people like yourself that are willing to help anybody and do the analytics on deals and help them out with that. And so I really appreciate you coming on the show and sharing your knowledge. And I didn't want to bust on you too much about our age gap, but you and I had talked about that a little bit pre-show. I did want to compare it because there is a lot of knowledge that we can share back and forth. And also when I've been through the shit show that I've been through, I like to be able to let people know what I think's going to happen, but there's no guarantees. And the downside with that is I'm going to be more conservative potentially, and that keeps me out of deals that maybe I should do, but we still always have a little PTSD about losing everything, right? So
Yeah. No, that's exactly right. I think that it's great advice. It's better to be overly conservative than overly aggressive. And yeah, it's been an absolute pleasure. Thank you so much for having me, Derek. I really appreciate it.
well, absolutely. And I look forward to seeing what you do in the future. So, and
Thanks, Derek.
to everybody listening, thanks a lot for checking out Generations of Wealth. If you've just found us, great to have you. If you're with us every episode, thanks for coming back. Please share this. Tell your friends about Generations of Wealth show. Tell them to go to thegenerationsofwealth.com. They can go and watch every episode that's been released. Also, you can go to anywhere that's, hosts podcasts, but really try and spread the word as much as you can. Give us all the likes, the shares, the love, the 5-star reviews, depending on where you find us. And until the next show, go out and live your vision, love your life. Thank you.
Thank you for joining us on another insightful episode of Generations of Wealth. May your newfound knowledge help you in leveling up your own strategies to get through the many obstacles to your money-making processes and bring you much closer to the financially secure life you truly deserve. Continue filling up your accounts and further polish your financial tactics by listening to more episodes of the podcast at thegenerationsofwealth.com. Because in your wealth building journey, there is no other way to go but up, giving you the chance to finally live your vision, love your life. That's all for now. See you on the next one.